Welcome back, everyone. With Q2 earnings season finally in the books, I figured today I would do a portfolio review, go one by one through public portfolio and comment on earnings. As I begin, I'll highlight what my thought process has been recently, and that is sometimes it's just important to do nothing. When I look at my portfolio, it hasn't really done much recently. Long stretch where it's been kind of just napping. But that said, I look at the individual names, I look at what the positions are and where, what else there is in the market, and I like what I have, and I'm comfortable with how the portfolio looks, and I've been looking, and when I look to add, I look first inside the portfolio and think, okay, that's where I should add. And overall, I haven't really been saying too much recently because I've not felt overly bullish or overly bearish, and I've just been kind of waiting for the market to kind of do its thing and sort through a lot of the noise that I think we're seeing in the market right now, like the supply chain chaos. That's caused all sorts of problems when it comes to autos, commodities, shipping, all sorts of things. So I really don't know, strongly don't know what the market's going to look like on the other side of the supply chain chaos. Will there still be an inflationary impulse? Will it be deflationary as things get worked out? I think I have an idea, but really we don't know what the new normal will be. We also don't know what's going on, what's going to happen next. So let's start with the worst performer in the portfolio being VieMed. And honestly, if this isn't a bottomless pit, certainly fooling me. So when it comes to VieMed, I continue to believe that the most likely scenario, and on Q2 was fine, wasn't as much as the optimists were probably hoping for, wasn't bad by any stretch of the imagination. So I continue to think that the most likely scenario is they get back to growth and continue to grow at a very, very above average pace. And the stock is very inexpensive considering that pace of growth, and they're well positioned, large market to grow into, and can keep growing for medium to longer term. If I'm right, that means something to the tune of above 20% organic growth and potential expansion through acquisitions, as their balance sheet is very clean. I think that while I timed the entry very poorly, as judged by the market, the price has transitioned from reasonable to good. And, I wasn't perhaps as, didn't discount this possibility, because what's very clear, and what I thought I had accounted for, but obviously did not, is there's a lot of noise in the direction of the earnings because there was a bunch of one-off events, one-off business, and so it got very noisy. I thought that I was finding it at a very reasonable price, transitioning back into becoming a very good company. Obviously, there was more noise or more confusion in the transition. So I do continue to hold VieMed and believe that it will be look like a successful investment in a few years. But it did make me realize that it's not necessarily the type of investment that sits the best with me. I was reminded of how I think about investing and how I examine risk and reward. And in this case, while I think it's a good company, and part of the reason I added it was because I thought it growth at reasonable price and quality in that sense. So what I kept thinking about is why that I will be wrong, and I need to make sure my mistakes get more than paid for from winners. And when we're talking about a solid company like this, that's growing and where the price can be in question, what are the one-off risks? And that's one thing I looked at too. What types of risks can just pop up and make you wrong? And how many other things would have to pay for the risk if that happened? And so while this has underperformed the market, my portfolio, whatever you want to talk about, it was a reminder and something to hopefully learn from that. For me, it's annoying because I thought I already knew it, but apparently I'm not that smart. Another addition that I made early this year was Aecon. And shortly after I did, well, in Q1, they presented, well, they didn't look like the best numbers right after. And, I think I said at the time that I don't really own them for one quarter's results, and that I thought that based on the conference call and based on their track record, that they would get back to business, I guess you could say. And Q2's results basically fully reversed the Q1 concerns. Now, I don't know if what happened in this quarter is enough to, obviously the result didn't send them into the 20s per share, Canadian I'm talking about. But if they can meet their guidance and if they can keep the trajectory and if they can continue really to grow the backlog, which again, they may not in a quarter-to-quarter basis, but if they can continue to do all that, then I think they will eventually move higher. The market seems like it's thinking that they are near peak earnings, and so thus they're inexpensive versus their history, but hopefully they can keep moving forward, and if so, the stock is very inexpensive. Next is Geodrill. So Geodrill in Q2, they undershot what I think consensus was and what the market was expecting. And the market seemed to sell it off after that. But when I was listening to the conference call, I'm not really sure that's justified. Why? Well, the rainy season came early and went early, and things sounded rather positive, and from what I've heard in the past about what the CEO has said said about business, he has seemed to be right. So for the time being, and looking at peers, it would seem that this is a rather interesting sector if they can meet what it sounds like they will, price is exceptionally reasonable. Now, it's hard to know in this type of sector what's going to happen a few years out, but in the meantime, they seem to be very reasonably priced and things seem to be going fairly well. So we'll have to see what Q3 brings, but if the stock continues to sell off, I personally think of it as an opportunity, but again, who knows? Next, Dream Unlimited. So what I can say about this one is very little happened in that quarter. Kind of, NAV was kind of approximately where it was before. But when I listened to the conference call, I was kind of, I can't really repeat it because there was too much going on, but nothing in this quarter. Growing the asset management business very quickly, growing book, completing projects, but just very little NAV growth in the quarter. So a lot going on. Very pleased with the track that's going on with this investment, this company. Continue to be very happy to be bored by it going sideways. Next one is the newest one, and that's Voxtur Analytics. Q2 was basically as okay as I expected. Really, if you look back at what they were saying a long time ago, not really expecting much much of the growth to hit until later in this year, and Q3 this year, Q4 this year. So hopefully going forward, they could recognize some of that. The recent acquisitions do add a fair bit of revenue profitability, hopefully. And so, unfortunately, there's probably also a wave to a surge of foreclosures coming, which again weren't really happening in the first half, but would only be additions to the business and profitability. So in terms of what is the right valuation for Voxtur, I have no idea. You know, traditionally this type of company, people talk about price to sales and have some price to sales multiple that often seems very high to me. I don't really look at things in terms of price to sales. I don't really see the point. I do get how it can be a useful metric, but when I've seen some people kind of suggesting what they think this company should trade at based on peers and whatever, I really don't know. What I can say is right now, if we're looking at forward price to sales, it's like 2, so I don't really think it's trading at that, or if it is, it's, you know, who cares? I look at EBITDA or earnings or something along those lines. I know it's not really that popular, especially in that type of equity, and I also understand why. But I think that sometimes people that assign high multiples, they look at US large caps and think, oh, well, this Canadian small cap should get that same type of multiple. Not sure about that. Just generally, stocks in Canada many are less expensive than traditional in the US. There might be reasons, might not. Who knows? Maybe that's just me generalizing. Maybe not. But it's definitely a huge market, huge lot of avenues for growth, and hopefully they can execute on many of them and make this investment successful. Still very much a wait and see how much success they can actually have type situation. Arch Resources, probably last year's biggest disappointment, but recently has been coming out of its hole, I guess. It's probably mine. Anyway, the market that Arch is selling into is rapidly moving higher. I think prices hit, I don't know if it's all-time highs or decade highs. Prices are very high of coking coal, and this is a great time for this company because they have a new mine that is just about to be coming online and just about to be ramping up. So great timing on that. You get the growth maturing. Hopefully we get the re-rating from the growth. Maybe we get the full cash flow. Some of the math begins to look silly if you think this price is going to stick around for any limit or any lengthy amount of time. Even it was much lower at the time of the conference call. And if you listen to the conference call, they do some quick math, and just based on the quick math, net of the cash costs, Lear South, which is just the new mine, once it ramped up, would be around $35 a share, and their legacy met coal business is much larger. So, you know, obviously the market the market is not really thinking that these prices will stay longer. Maybe the market's right, maybe it's wrong. You never know. But again, the reason I like this at the time and the reason I was comfortable sitting on it is because they make money at low prices and they make a lot of money at high prices. Right now we're seeing very high prices. But the success or failure of this as an investment from here on out really depends where the prices will be for the next 5 years. That's essentially the time frame that you can look at in value, probably even less than that. But if the prices stay here for the next 5 years, this will go very well. If the prices crash tomorrow and stay low for the next 5 years, well, then it will obviously go very poorly. Likely we get some of both. Market has to kind of figure out how much of each, and that's the determining factor here. Another recently popular one, Sprott Physical Uranium Trust. Wow, it's moving these days, and it's trading above NAV, and it's pulling the NAV up with it. nothing really has changed of my view of where NAV should go. I might say that given the momentum, and there's a lot of, for sure, a lot of things that could slow it down along the way. But if it keeps moving this successfully, if this keeps moving it very strongly, I would say that perhaps my view of where NAV more likely would go in terms of a mid-cycle type place might be a bit higher, but again, it's very hard to see what's going to happen once we get to a point where there's a debate, more of a debate. I guess there's always a debate, but more of a debate in terms of what price is right. So for now, not really earnings, but I put it in here because otherwise, you guys would all ask me. Melcor. So this is one I'm fighting my bullishness on. I'm really bullish this stock for a number of reasons, and I honestly I think it gets better from here, and very few might know this or care or something along those lines. But Q2 was their best Q2 ever in terms of funds from operations, and that is including back in when what people would refer to as the housing bubble, back when oil was very high and they're in oil land. So the market's treating this like it's peak earnings, but I kind of went through a little thread about this on Twitter. I don't necessarily see it that way. I think there's a lot of room to run in housing, and I think we need more supply. And here you have a company that literally builds houses and trades at 40% of book. And guess what's happening? Insiders are buying like crazy. The buyback is running because it's very accretive at 40% of NAV or whatever it is. So I really think that the sector has strong fundamentals across North America, really. And there's a lot. I was telling someone the other day, and they were asking, what do I like recently? Low risk, or not low risk, but like real company type thing. And I was just talking about, there's a lot of writing on the wall here, and a lot of writing on the wall that this stock could do fairly well, and a lot of writing on the wall that, what do you want to see in a stock? You want insiders buying, you want growth, you want, a company that has proven it can do it in the past. And, if you look at what they did from the early 2000s, they've proven that they can grow. Now, can they refine their groove? Maybe, and could do fairly well if they can get back to growth, because they're significantly undervalued compared to the book right now. So if they can start growing the book again, that's a lot of torque. And so, yeah, Q2 was very good, but market didn't care. Next, Dynacor. They had a fine quarter. They spoke about, I think it was since that they spoke about potentially increasing the guidance. I saw that and I'm like, oh, really? And then I looked back at guidance, and I mean, their guidance was, I guess, a bit below where mine was, so might make sense, or where my thinking was, so might make sense. But again, I'll let them run the company. Get as good results as they could. Dividend was raised in the quarter, so that's positive for shareholders, considering that they still have a substantial amount of cash on the balance sheet. Again, same type of commentary as last time. I would love to see them put more of the cash to work. Still very fairly priced, plenty of net cash available for either distributions. They could pay a special dividend too if they wanted, but that's not what I see coming. I don't see anything specific. But they can do a lot of things. Hopefully they can use that money to grow. So next is Verde. And I think my issue and why I wasn't necessarily blown away with Verde's numbers is because when I was thinking about it, I was often looking at a few things. And one is that I was looking forward at forward potential, and I was kind of, when I calculate numbers, I was thinking, okay, well, if they can do this, if they can do this. And I was looking forward, and thinking about what they could do. The other is that when I looked at pricing, I was looking at current pricing. Very little of that was seen in Q2. So basically, when I initially looked at Q numbers, it came to it felt a bit on the low end of the estimates. But there are some very valid reasons for that. One being there was a drought in that quarter in Brazil, so the pace of growth in sales, in volume sales, which is really the thing to focus on, in my opinion, the pace of volume sales decelerated. And that, if that's just due to the drought, then, and the guidance, the volume guidance, if that's met for the rest of the year, which, I'm watch like it will be, we'll see, obviously. But if that gets met, that means a reacceleration of growth in the second half of the year, which is a type of thing that markets generally like. Now, 35% growth year over year, that's not bad. It's not bad by any stretch of the imagination. So we'll have to see if they, receive the pricing that looks something like the current spot, whether that's discounted for FOB or if they sell at CIF, whatever, we'll see. Hopefully pricing stays strong and they can make a fair bit of money and pay for phase 2. Hopefully they can meet their volume growth guidance in the second half of the year, which will mean that earnings or that volume growth acceleration, markets will like it. And if they can do that, if they can continue the pace of growth second half, they'll be fine. Better than fine, probably, eventually. And if prices stay strong, even better. Next is Linamar, another one where I feel like it's so cheap that there's got to be something I'm missing. Linamar trades at about 4.2 times EV to EBITDA, which is pretty cheap. But the thing that makes me feel like there's something the market's missing, or that I'm missing, is that this is chip disrupted EBITDA. We're talking about, the chip shortage. Why? Well, how do we know there's a chip shortage? Well, automakers are telling us because they can't make cars. And while Q2 or Q3 might be the peak of the disruption, now companies have guided for Q2, but we never know. Could get worse. But as I commented on the conference call, car inventory very low. And you can see that in many places, meaning that as the markets get back to normal, even if actual demand weakens, we still have inventories to rebuild. So auto making should be stronger than auto demand going forward. And so I just feel like a crazy person when I'm saying, yeah, but shouldn't they be growing EBITDA next year or shouldn't they be growing EBITDA earnings? And this is a company that has done so in the past, and they say they're going to do so again, and it looks like they should, and if you logically reason it, kind of feels like they should. So, they're forecasting double-digit growth next year, and they're trading single-digit price to earnings, single-digit, low single-digit EV to EBITDA. Balance sheet strong. So, I don't really see what the market's thinking, but I guess it has its reasons. Lastly, we have Global Atomic that I'm just including as a courtesy because, again, it doesn't really trade on earnings. Not too much has happened. They've confirmed what I kind of suspected in that they're keeping 90% of the project. Still awaiting the feasibility study, hoping that the turn comes in the perfect time of when the price is, screaming higher. Hopefully, we'll see. So yeah, that's not much new to report in the quarter. So overall, I'm pretty happy with the value and the setup balance within my portfolio, and it's one that, while may not have the most leverage, may not have the most upside, may not have the most quality in all names, but I think it's a good balance for me, and that lets me sleep well at night. And the companies that are in it, I think, will be substantially more valuable in years to come. And I believe that if value gets there, I'm less concerned with what the share price is than day to day, however you want to put it. And here, if anyone's curious or wants to see in detail how the portfolio is doing, these are the stocks from 2021 at the associated cost bases. And here are the stocks from 2020. And just to address this, the total gain percentage number is completely wrong. I've calculated it, if you're curious. $65,000 invested, total gain 154.7% approximately. Pre-tax and pre-dividends though, because there have been some things that have been sold. So 65,000 invested, 76,477 approximately of risk capital taken off the table, the rest being the balance up top of 88,927. And so that was the stocks I invested in last year. Now, if you compare those results to last quarter, it might not be a fireable quarter, but it wasn't a good one. It was slightly up, probably underperformed the market, and was not, nothing special. Was approximately flat, but fundamentally, I believe that a lot of the stocks showed some good improvement, showed some de-risking of where we currently are, and some growth in general, and are stronger than they were in the past quarter, even if the price hasn't moved much. So that's really all you can target or hope for, and hopefully the market will readjust in its time. In conclusion, I hope you all enjoyed. Remember, this is not investment advice, not now, not in the past when I mentioned that I was liking these ideas on the channel. Any commentary or criticism or suggestions on the stocks is welcome, provided it's done in a polite way. Always interested in what your thinking is. And with that, I wish everyone a great day, and until next time, enjoy.